Well, good morning and welcome to the Experian Quarterly Business Credit Review for Q1 2020. This morning we'll be introducing three very knowledgeable economists and experts two from Moody's and one from Experian. They each have done a deep analysis of Experian's Q1 business credit data published in the most recent Experian Moody's Analytics Main Street report. And the review will be presented in three segments. Our presenters today are Brody Oldham from Experian. He's the Senior Director of Analytics Consultancy. Presenting from Moody's will be Christian Doredis. He's the Assistant Chief Economist. And Associate Economist Derek Grunfelder. To make sure you get the most out of today's session, getting to answer your questions, we encourage you to raise your hand by submitting your questions using the Q&A tool in the applet. And we'll try and leave some time at the end. We've got a full program today that we'll try and leave some time at the end for questions. If you want to follow along and download a copy of the deck, we have put it on the site. There's a URL in the lower right corner of every slide on the presentation. If you go to that bit.ly link, you can get a copy of the PDFs before we send them out. We will be sending a link to that in the event follow-up emails and a copy of the recording. And now I'd like to introduce Christian Doredis from Moody's Analytics to head us off today. Welcome, Christian.
For our outlook, and certainly it's been quite a quarter, to say the least here. So do look forward to providing you with some information about what's going on in the economy currently, as well as our forecast. And then I will turn it over to Derek to go in a bit deeper into the actual credit, small business credit information. There are 7 points to my economic outlook. 7 we know is the perfect number, so 7 is appropriate for our discussion here today. So I'll be rolling through these 7 points relatively quickly. The first point to make is about the virus itself, about COVID-19, and certainly we are still in the middle of the pandemic here, and that has to be front and center. Although we had seen some improvement in terms of number of infections, and there had been some indication of some improvement all around in terms of death rates and whatnot. The pandemic itself, the spread of COVID-19, remains front and center in terms of the actual economic outlook. So we do need to give that some consideration. It's something we are tracking very, very closely. On the slide, you can see the progression in terms of the number of cases on a daily basis. Yep. So you can see the trajectory of COVID-19. That is front and center in terms of our economic outlook. And certainly, if we don't see an improvement in terms of the case counts, we will have to continue to adjust our forecast and certainly push out some of the potential recovery. The second point to make is around the reopening of the economy. So if you could move to the next slide, please. We can see that there are areas of the country that are opening up relatively quickly. The number of counties that are actually opening up there or reducing their lockdown restrictions has declined. Hopefully you can see that on the chart. And you see that the economy is coming back online relatively quickly. We've seen some improvement in terms of retail sales. We got a data point this morning. So clearly there's some evidence that the economy is restarting. We are seeing some positive movement there. If we, the number of folks filing for unemployment insurance each month, are you able to see the slides? Let me interrupt here just a moment. Just to confirm. So.
Yes, Christian, we're currently looking at the slide, the job market remains weak. Is that the correct one?
That is the correct one. Okay. Yeah, so the job market does remain weak. We have the number of unemployment insurance filings remaining improving, right? So we're off the highs, but still we have well over 1 million people filing for unemployment insurance on a weekly basis, right? Even at 1.2, 1.5 million, that's well above the 200,000 or so that we had prior to going into the crisis. So although things are improving, they still remain relatively high, so we're far from normal. The slide gives you an indication just in terms of the magnitude of the job losses, the unemployment insurance claims by week. I'm showing you the equivalent state populations, right? So just to give you a sense of the magnitude of the unemployment insurance claim filings on a weekly basis. So, for example, last week we lost the state of Hawaii in terms of the number of people filing for jobs. And if you add up all of the job losses over the COVID period here, it's over 40 million, right? And that's larger than the population of California, right? So just to emphasize the scope and the scale of the job losses that have been incurred, even though we had a positive job report a couple of weeks ago for the month of May, we added back 2.5 million jobs. Still, long way to go in terms of improvement in the job market overall. What we can see is that the job losses have been certainly large. They've come swiftly, but they haven't been distributed equally across geographies. They haven't been distributed equally across industries, or in the case of this slide here, they haven't been distributed equally across businesses of different sizes. And so what I'm showing you here is data that we have from ADP, the payroll processor, and showing you the size of the payrolls as measured by ADP for February, March, April, and May, right? Those are the four bars that you see. And I'm breaking out the number of jobs on the payroll by size of organization or size of institution. So you can see across the board, all institutions of all sizes lost jobs, and they lost millions of jobs. In terms of the absolute number of job losses, it is the larger institutions that incur the largest number of job losses. It shouldn't come as much of a surprise. Large institutions have lots of employees, so even a small percent change translates into a large number of jobs. But if you look at things on a percentage basis, in terms of which category of businesses lost the most jobs on a percentage basis, it's actually in the middle of the distribution. So businesses with anywhere from 20 to 500 employees are the ones that saw the largest decrease in the payrolls on a percentage basis. So the smallest businesses, although we certainly see job losses there, and we pay a lot of attention to what's going on within that category, to some degree they've been able to stay afloat thanks to some of the government support that's out there and some of the other trends and innovation that small business owners certainly present in terms of keeping their businesses going. But in terms of who has taken the largest hit, it's been more in the middle of the distribution rather than at either tail on a percentage basis. So that's certainly something to bear in mind as we think about recovery and who needs to recover, who's most at risk in terms of a recovery. If we move to point 5, the geographic impact of job losses has also been differential across the country. Right, on the map here, you're seeing the change in employment rate by state from April of 2019 to April of 2020. The states that have seen the sharpest impact in terms of increase in unemployment rate as measured by the BLS should come as no surprise: Nevada and Hawaii, which have very large exposure to the tourism industry, leisure hospitality industry, right? Given the nature of the COVID-19 shock and the disproportionate impact on those industries in particular, right, it's no surprise that they've seen a very sharp increase in terms of the unemployment rate. In third place is Michigan, the state of Michigan, which has actually seen a lot of job losses because of the manufacturing impact. Auto sales, auto manufacturing had been way down. We're starting to see some signs of life coming back to that industry, so that certainly is a positive. But through April, at least, we hadn't seen much in the way of recovery there. There were still quite a few folks out of work in that industry and in manufacturing overall. So you can see some of the neighboring states that also support auto manufacturing in particular, also taking a fairly significant hit when it comes to unemployment. The states that have fared best, meaning that their unemployment increases have been smaller, no state has actually improved or remained the same. They've all seen a deterioration in unemployment. The ones that have fared best include Connecticut, Minnesota, and Nebraska, with smaller increases in the unemployment rate. But again, that's not to say that they are not suffering or not feeling the pain of the economic shock here as well. But there certainly are some differential impacts, and if you are a lender to the small business community, you certainly would want to take into account your portfolio's concentrations in terms of assessing what the potential losses might look like for your unique situation. If we move on to my point 6, the one bit of good news, and at least in the short term, in terms of ameliorating or preventing some of the effects of these large job losses from flowing through, has been fairly generous government support in the form of direct payments to households. Those are labeled as economic impact payments in the slide here, as well as unemployment insurance and other support from the federal government to households. So although households have to deal with a very weak labor market, to say the least, and the potential for significant income loss, at least in the second quarter, what we've seen is that the government support has actually more than offset those losses in wage income. So for that reason, we may not have experienced the full impact of this shock quite yet. We've managed through government support to offset much of the direct impact in terms of household finances. The chart here, what it's showing you, is the variation in overall personal income. That's the dotted line that you see here over time. What is the change in personal income relative to the end of 2019? So as we look through this cycle, as we look through the most recent data as well as our forecast, what do we anticipate in terms of disposable income? And then the bars in the chart are breaking down the positive and negative effects on that disposable income, or the positive and negative changes on that disposable income. So again, for the second quarter, you can see the light blue bar indicating a very significant decline in earned wage income, because people are unemployed, they're on furlough, they're not earning their paychecks, but that has been more than offset by expanded unemployment insurance benefits in orange, economic impact payments in green, and the other automatic stabilizers or transfer payments in blue. So at least for the second quarter, households by and large have been able to maintain their finances. That could be a reason why we haven't seen household delinquency rates skyrocket at the moment, or certainly not to the extent we would expect for such a high unemployment rate. However, we should be cautious, because as we look forward, as these fiscal payments expire, as these government programs terminate later in the summer and throughout the year here, you can see that we are expecting that the overall impact on disposable income will be negative, right? And that's presuming that unemployment does stay relatively high at an 8 to 9% level throughout much of this year, and then it does take the better part of 2021 to have our economy regain even up back to the level that we had prior to the COVID-19 crisis. And that's really just under a baseline scenario. Okay, before I move on to my last point, point 7, I did want to stop and ask Gary to pull up a poll question, if you're on the line here. And the question is, and I think everyone should be able to see this on their interface on the right-hand side of the screen, is, we talk a lot about the potential recovery and what this recovery might look like. There are a lot of prognostications based on letters of the alphabet. Will this be a V-shaped recovery where we've seen a sharp contraction? Will that be followed by a sharp improvement? Will it be a more U-shaped recession where we've contracted hard and we're going to bounce along the bottom here for a while until we get some improvement later on? Is it more of an L-shaped where it's more of a permanent downward shift? We've lost a lot of output in terms of GDP and the labor market overall. Are those job losses more or less permanent for the foreseeable future? Let's say the next 3-4 years. It's going to take a long time for us to really get back to where we had been previously. Is this more of a W shape in which we certainly saw tremendous loss of output in the second quarter. We may see a pullback in the third quarter. We've already seen some improvement in terms of labor market statistics and retail sales and some other more recent data. But are we setting ourselves up for another fall with perhaps a contraction in the fourth quarter or in 2021? So the poll question on the right here asks you to select the letter of the alphabet that you'd like, or if you prefer more of a check mark or a swoosh type of recovery where the economy has gone down and it's going to just take a very long time for us to recover out of it, or something else. If you have another letter of the alphabet in mind or a different scenario in mind.
So it looks like the swoosh, it gets the majority, although we didn't have the majority participate in the poll, Christian, but 8% think that we're going to have a swoosh recovering.
Okay. Well, that is consistent with the Moody's Analytics view, with my view. So if we turn to the last slide here, the 0.7 slide, I'm showing you our real GDP forecasts under a variety of scenarios. So Moody's Analytics, we produce a number of different scenarios. The baseline view in purple is right in the middle of the distribution here, and it represents our 50th percentile view, meaning it's a 50% chance the economy could perform better or worse than this particular scenario. And that is very much a check mark or a swoosh type of scenario. We see a sharp decrease followed by a relatively long period of recovery. And it's not until really 2022 that we recover back to the level of output that we had at the beginning of 2020. And so I agree perhaps with much of the audience here. I do think, though, that the risks are certainly weighted much more towards the downside than the upside at this point. Although some of the recent data does look more V-shaped in nature, very hopeful that things move in that direction. I think we have to be mindful of the potential second wave or some other downside risks that could pull the economy down again before we really set ourselves up for a more robust recovery. Okay, with that, I'm going to turn this session over to Derek to talk about some of the small business data and details that he's been tracking very closely. And then certainly if there are any questions, we'll be happy to get back on the line to delve a little deeper into any of these economic issues. Derek?
All right. Well, thank you, Chris, for the wonderful macroeconomic overview and sort of backdrop that small businesses are facing right now. And good day to everybody on the call. Thank you for tuning in. I always like to start out by thanking our partners at Experian for providing us this data to work with. It's a fairly large data set. Almost 8 million small businesses are captured every quarter so that we get as holistic a view as possible of the credit environment that small businesses are facing at any given time. So jumping right in the first quarter, we saw that delinquencies in the more severe category of 31 to 90 days past due remained about 1.6%. And this is sort of what we expected because the shutdowns in the U.S. didn't really start until the very end of March. So businesses were still operating as normal in January and February. And for the majority of March, business continued mostly uninterrupted across, again, most of the country. Once we're getting into the rest of the year is where the question marks start to pop up in our minds. And I want to jump right into my poll question, Gary. So if you can throw that up on the screen for everyone. So this question is the percentage of our clients or customers, or your clients or customers, who have asked for a delay in their payments or have missed payments. And the options are 5 to 10% of clients, 0 to 5%, 5 to 10%, 10 to 15, or over 15%. So if you all want to go ahead and answer that.
The responses are coming in.
Oh, wonderful. While we're finishing out the time for this poll question, The reason that I've chosen this as my section's poll question for this quarter's webinar is that the Census Bureau has started doing small business pulse surveys, which are going to run, I believe, through the end of July. And they just started those, I think it was the end of April. So we're going to get a little bit of additional information from the Census Bureau about the conditions that small businesses are facing. So on our call, I wanted to gauge your responses to a question similar to one that the Census Bureau has asked. Are the results in, Gary?
And it looks like, 17% of the audience have indicated D, 15%. Followed closely 10 to 15% with 16%, and then 15% indicate between 5 and 10%. So,
well, the good news for everyone on the call is that at least a plurality of you are right in line with the national average. So as of June 6th, the Census Bureau reported that 14.9% of small business respondents had reported missing at least one payment, at least one non-loan payment. And if you consider loans, they had missed, or an average of 5% of businesses had missed a payment. So a lot of you that are reporting these numbers are pretty close in line with what's happening nationally. So we have a good representative audience of the small business conditions in the U.S. So if we move on to my next slide, and I hope that this is transferred for you. I hope I'm not having any technical difficulties on my end. So interest in bankruptcy is on the rise. And what I did for this chart was using Google Trends and searching for the term business bankruptcy. And I'm hoping to put out a short piece on this as I do some more checking. But it seems like interest in business bankruptcy and increasing searches for this term correspond with about a 4 to 8 quarter lag with a rise in the bankruptcies that we see in our own bankruptcy data set. So I'm going to move on to my next slide right away. Oh, I shouldn't do that. So our bankruptcy metric, which is shown in the quarterly report that we published last month, still shows that bankruptcies in the first quarter were about even with where they've been for the last couple of years. We haven't seen them move off of their floor at all, but what's indicated on this slide is that over the next 4 to 8 quarters, we should be seeing an uptick in the bankruptcy rate reported that we receive from Experian, and that is in the small business data that we put out in the Main Street report. So now I will move on to the next slide and show you a bit of a breakdown of what's happening across the country. So again, looking at that medium to more severe days past due or delinquency rate of 31 to 90 days, you can see across the BEA regions that the plains have really been or had the most severe delinquency in the first quarter. And there should be quite a bit of reshuffling. If you recall Chris's slide of where the job losses occurred, I'm expecting that, places like Michigan, California, where they closed down very, very drastically, very early. So the far west and the Great Lakes should be experiencing some more small business credit pain in the second quarter. So I'm expecting that this chart is going to look a little different the next time that we have this webinar. But for the moment, in Q1, when things were still open, the plains did have the highest delinquency rate among the BEA regions that we use. On the bright side, since we already have some data for Q2 coming in, we had the Google Trends data. Here we have the Senior Loan Officer Opinion Survey from the Board of Governors at the Federal Reserve. In the second quarter, and even to some extent in the first quarter, we've seen a trend that had been well established for quite some time of loan officers, such as many of you on this call, reporting that demand for C&I lending was not getting stronger at your establishments. And it looks like, thanks in large part to government assistance through PPP loans, economic injury, disaster loans, and other programs put out by the government, we will see a bit of a change in this trend. So small businesses are starting to pick up their lending and really try to get a bit of a cash cushion on hand so that they can weather, what was happening with the closures in the second quarter. If there's a second wave, they'll probably be holding some more cash on hand to absorb any such shocks. So this virus is and the resulting economic injuries are causing some shakeups, even in places that we wouldn't necessarily have been expecting in the first quarter, just from looking at our own small business credit data. So looking more at the PPP program, or Paycheck Protection Program, the uptake of this happened very rapidly. So these efforts were started back in March and April, and they really kicked in May, was when a whole lot of this was hitting the economy and small business lending. Since then, it's kind of tapered off, although there is still some capacity for small businesses. But as a result of this, we do expect a large bump in new issuance credit for small businesses in the second quarter and beyond, as I mentioned. So we should be getting a lot of new data and potentially a lot of new businesses. So I'm sure you are all aware, in the beginning of the PPP program, it was mostly businesses with established relationships with their lenders who were able to get in the door first and really kick off the uptake of these programs. So after that, in the second round of PPP funding, a lot of new businesses were coming in. So that 8 million number I mentioned for small businesses that are present in the data set we work with could be rising and potentially substantially going into the second and third quarters. As I mentioned, PPP isn't the only program that's out there. So the SBA is also working on economic injury and disaster loans, and they haven't provided loan level data for these as they have with other SBA lending in the past. And in fact, their most recent programs have delayed the loan level output that they had previously provided. So we aren't able to give you more of the SBA view, SBA loan, the 7A and 504 program lending that I normally like to show on these webinars. But we can show you the EIDL program lending, which has surpassed $90 billion as of June 6th. So the SBA has responded rapidly to get new credit products out to help cushion small businesses and get some cash on their balance sheets during a time when they otherwise wouldn't have access to it as a result of the shutdowns. So hopefully that will help a lot of small businesses survive, and next quarter we'll be able to look back and say, these programs really made an impact because a lot of businesses have remained in the data sets and were able to get through shutdowns that were happening across the country. So with that, I will leave you all for the first quarter and turn things over to Brody.
All right, thanks, Derek. Well, April and May certainly have been a whirlwind of activity, and we've seen some of that in the macro update that we got from Christian this morning and Derek's insights on small businesses. Certainly helpful. You know, I really enjoy these quarterly events where we get together and share and absorb the insights that are coming in. Just it gets me excited every quarter when we have an opportunity to get together, and that's why I encourage all of you to join these sessions where we get together and talk a little bit about what's happening in this ecosystem. You know, besides Chris and Derek, I like to thank Rick Tran on my team, on our commercial data science team, for helping me pull together some of the trends for today as we review. And we're going to do a few things a little different today. So as we've seen small businesses coming through the first quarter, they've been pretty stable and running their growth strategies really through about February. What we saw in March and April, we saw a dynamic shift as the pandemic came in and shut down whole cities for public safety. And we saw lending slow and in some cases even stop, and we're going to point out a few of those today. But government programs came in and injected some capital into businesses and families, and we're going to see some of the impact that those programs have already had today. So the preparation, pre-recession planning, the capitalization that some of our lenders have had in this small business lending ecosystem, really from the last recession to now, have helped to soften some of the impact of the shutdowns. And I'm excited to get into some of those trends with you today. So I'm in my home office, and like many of you in this COVID environment, I'm set up for an extended engagement. And many of my colleagues, some of you, are really looking at how they're going to operate their businesses in the near future as far as site resourcing. It's going to be a real difference. So I've got my setup going. So I hope you sit back here and enjoy the next 20 minutes. You may hear a potential dog bark. You may hear my coffee pot gurgle a bit. And hopefully you won't hear one of my kids asking for Wi-Fi support as their IT technologist here at the Oldham household, so we'll try to keep that to a minimum. So let's jump into some of the trends today that we'll see. And I always like to start with consumer credit. So small business owners have been known to use their personal credit to prop up a business during tough times. And what we've seen in the weeks leading into June is really a slowing of bank card originations and lowering of that origination amount for what they're getting on their credit cards as far as the limit. And this has been pretty expected as lenders are turning on those recessionary underwriting strategies. And so we're evaluating how that's impacting the small business performance. So we know that small business owners also will use the equity built up in their home to pull cash to continue operations during a slowdown. And certainly during COVID, that has been important because, like Christian mentioned earlier, it was a drop-off, a wall that was hit where businesses were closed down immediately. So these home equity loans have been harder to come by when we think about injecting some cash from personal credit. And that's been happening because the consumer credit market has been pivoting a bit. The good part, home prices in the U.S. continue to trend upward, and we've seen rates get some relief, and refinance options are certainly more attractive. We've looked at them at the Oldham household here. So that's positive during the slow period. Home sales have slowed a little bit, and you can intuitively think of those regions that have done it. Northeast certainly due to COVID, but some of that pent up demand by home buyers is being released in some areas, certainly looking at getting out of the city and into some of those more rural environments and spreading out a little bit more. So there will be some of that lifting that housing market, certainly around larger cities. So this is cushioning any slip that we would have seen in home prices at this point. So that's another bright spot. Support and guidance really provided to consumers through loan modifications, payment holidays. Lenders like you and the bureaus have really supported, again, in creating a cushion for consumers over the past couple months. And some of you have heard some of those strategies as we go. And our hope is really that the pandemic is going to subside. We really hope that. for our nation and for our world, and that the shelter-in-place orders will begin to be lifted, and they already are, really creating an opportunity for consumers to get back out there, spend, get back to work, and we want this to happen quickly, not only for the market, but for personal reasons, so that consumers don't, when we look from a business owner or consumer aspect, we don't want them to get too far behind in their balances. We know that balances are growing, and we also know that utilization rates are growing. So as those markets get a little tighter in the availability of credit, consumers and small business owners are using the credit that they have, what's in their commercial wallet at this point, and you'll see some of those utilization rates increase as they can't go out and get further access to new credit. So a lot of positive views here as far as consumer products, and it's really a way that on the consumer side, consumer products can help small business owners really find funding when businesses are stressed. And when we see the tightening in consumer credit criteria, we look at how commercial lending facilities really creatively fill the gap. And we're going to look at some of that a little bit today. And we're going to focus a bit on a data source that we have here at Experian that has very granular data. It's made up of small businesses with tens of millions of payments a month across a wide array of industries and products. It's called the Small Business Credit Share. We talk about it every quarter. It's a cool data set. It's a focused consortium set of data. It includes expanded payment performance data on products like lines of credit, commercial credit cards, loans, and leases. And it's really a great way for you to look, and one that we use to look for signals that are predictive of future originations. We also look at payment behavior and delinquency, and we're going to show you some of those trends today. And these trends really play a role in signaling recessionary behaviors and challenges for specific industries. And I've had even questions about that this morning, early in the morning till now, right up until we started asking for those specific behaviors. And our goal today is really to look for some of those signals across a few just key commercial products. We'll do some call-outs, point out a few points that show that strength and stability in the marketplace that we had in the fourth quarter and coming into the first quarter, and then where we will see really some challenges going forward. Now we're going to start in March 2020 as the shelter-in-place orders were really kicking in. And small business lending was slowing across installment loans and lines as lenders were really preparing for some of these market changes that we could see in the future as the spread was increasing. We knew that there would be challenges that are out there. The concerning trend was really that those that were slow payers, and you can see it's a trend that goes across all regions, those that were slow payers, that they had delinquent payments past 30 days beyond term. And for businesses, as they get a little bit larger, they slow pay a little bit more. But we were really seeing those that were delaying payments and going into that 30 days beyond term, that they were more likely to roll into some later stage delinquency buckets. So something that we really keyed in on. And so for commercial credit cards, the slowdown in origination was compounded by a lack of the ability and availability to get longer-term lending products. And that really meant, again, what we talked about before, utilization on lines and higher risk balances were on the rise. And that was coming in to our March time frame. Now, what we'll talk about next is what happened in April. What happened as we were coming into this March time frame and delinquencies and our originations were slowing, delinquencies were beginning to arise. Well, for the commercial installment products, we saw a significant lift, and you heard Derek mention it. We're going to see a significant lift in that Paycheck Protection Program, and we see that certainly here on the far right you see the big bump in installment loans. And lenders were really originating loans that had a good and still have a good potential of being forgiven. Now, the loans that they were originating had some guidance, but it was really meant to support consumers and small businesses in need, and not just those that were low risk, so a little different from a normal lender policy. So the volume was high, but their limit amounts were lower. And this meant that lenders were flooded with applications, and when I say flooded, they were flooded. We had calls, we did advisory councils, people looked at their origination volumes in multiples of what they had had in the past, and it was overwhelming staff. And so these applications came in to really tap into more than $600 billion in grant-like loans for small businesses, and it created a spike at this time where you would normally see, like Christian said, an origination pullback. So something a little different here for installment loans. Now, with these looser requirements in origination, fraudsters are on the prowl. And I say are because this program is still out there. We have these offers that are available. Fraudsters know that this is a way to get in and do some malfeasance. And so you've heard the stories, people making up payrolls and employee counts, a lot of synthetic identity being created out there for both businesses and guarantors. We're going to see as bankruptcies potentially pick up over the next few months. We may see businesses that go out of business be resurrected. And how many times, when we get around Halloween, we talk about Frankenstein fraud, those businesses that have gone to the grave and are now brought back up and resurrected by fraudsters to come out and apply for credit. So you've always got to be thinking of what's the next fraudster step. Now, fraud during these events always rise too because our defenses really come down. We want to help those that are in need, those small businesses that need help. And that's admirable for the market, but our vigilance is very important and is still required to spot those wolves in sheep clothing, which we will certainly see more of in the near future. Now, what this new application volume really meant for lenders is that their balance sheets are going to hold some higher risk accounts than they would normally originate, with the promise that most of that higher risk debt would be forgiven. Now, when we broke the portfolio trend by risk segment and industry, you're going to see an average balance for each industry, and you'll see that noted here by the dot with the balance amount posted next to it. And we see that across all industries, portfolios really became more risky. And there are other forces at work here outside the pandemic as global trade tensions expand and contract, border closures and shelter in place really globally impact supply chain. And what other factors that we're seeing are energy demands falling and creating gluts in the market, and that really creates some price volatility in the energy markets. And I'll say one thing here. In Texas, we saw gas at 52 cents a gallon. And I'll say that again so you hear me right, 52 cents a gallon. That's a price I'm going to tell my grandchildren when I'm sitting in a really hot room watching TV that's too loud with 3 blankets on my lap and talking about the good old days. And it's really fun to look back and say 52 cents a gallon. But in today's reality, that volatility is really creating some market challenges. So what I want to draw your eyes to here and over the next few slides is the space where we see the arrow. The highlight that you'll see that I'm trying to bring to light here is an increased polarization that's going to affect portfolios. As the accounts shift away from low-risk paper to more risk in their portfolio, you're going to see that certainly more highlighted as we continue, and certainly in the installment loans as we go forward. Now, the next trend we want to look at are the overall commercial installment delinquency trends. Now, we broke down the U.S. into regions to identify areas of strength and potential weakness. Individual regions have specific mixes of industries and market drivers, and delinquencies on installment loans are up across all regions. Here's that trend that Derek was alluding to. It's coming, the delinquencies are going up. He mentioned it as part of the census survey, and it's something that I look at that survey too because I think it's very insightful. But you're seeing that across all regions it's going up, and you see that Northeast is taking the brunt of the impact. These delinquency trends are really tempered, though. Even though they're on a good upward trajectory, they're tempered by that injection of capital, of cash, really, into the ecosystem through the PPP and EIDL programs, and most recently, coming up, the Fed debt repurchase program. So keep your eyes on those as we go forward. Now, I do want to do a quick call out here of a segment that has been flourishing over the past decade or so. The fintechs lending in the market. It's really been a growing force in commercial credit. They lend to a slightly riskier set of paper, but have been very successful in a growth market. And we've seen them hit the wall in April. Fintechs needed to adjust the way that they were evaluating and underwriting loans, and some halted their operations in April. They had to. They had to reevaluate how they were originating the new paper. And their portfolios were already seeing heightened risk, and you can see some of that here in escalating delinquencies. But I'm happy to say that as we're coming into late May and June, that they're getting back into the market, and we're seeing some resiliency in some of these companies. Some were able to get in and do some of the PPP lending as well. So that certainly helped the survivability of that market. Now, I do want to touch on here unsecured debt facilities, such as commercial credit cards. And this commercial credit card market pulled back in April as lenders turned to their recessionary prep underwriting strategies, and it really created some tightening in the availability of these products, and we talked about that some in the installment section. Now, our expectation is that originations should continue to be low as delinquencies and some bankruptcy activity have the potential to continue to increase. We're certainly hopeful that the virus spread continues its decline and that the markets settle a bit into a rebuild mode, but that's certainly one thing that we will be watching as we go forward. Now, what you'll notice here is the opposite trend of what we saw in the installment originations. There aren't government programs here to forgive the debt or extend the terms. Lenders have the ability to modify these loans and the terms, but they haven't been given the guidance to really do so. So lenders have enacted their downturn response policies that tighten the criteria to help level out the increased risk already in their portfolios. And what we'll do next, just like we did with the installment section, is we're going to take a look here across all the industries. And what you'll see across the industry segments is really that there is heightened risk across the portfolio and really within all industries. All right, regionally, we've seen delinquencies on the rise. We saw those in the installment loans as they're originating some with some loose requirements on what's originated as far as those new loan products. But what we're seeing here within commercial credit cards is we're seeing the delinquencies rise. Now, they've been rising for a while. Lenders have been loosening their criteria, even going into the first quarter of 2020 to try to grow their portfolios. But in April and May, those delinquencies picked up velocity, especially in the Northeast, where we saw a greater impact of the virus. So we saw it slow a bit. So slow payments are on the rise in really the impacted areas, making May payments on April debt. And we're going to continue to watch these trends as we go forward to see if they're rolling into higher delinquency buckets, but you can see that the velocity is certainly picking up as far as delinquency trends. Now, with origination slowing and the ability of the business to acquire new products or manage the spread of growing debt and cash flow, the cash flow here is really the important piece because it's slowing and balances are growing, and you're going to see where the balances are growing. They're growing in the medium and high risk segments. And that plays into utilization as well. So without availability of new products to spread that debt across, you're going to see in their current corporate wallet that businesses that are struggling a bit more, you'll see that utilization and balance growth. So we'll continue to look at that. Now, we didn't talk a lot because of time about our line of credit, but line of credit products are seeing the same thing as far as originations down, delinquencies on the rise, and utilization really growing. They're in lines that haven't been adjusted or modified. So commercial lenders were really prepared. That's what we wanted to talk about today for a downturn. They weren't prepared for the speed that the virus took and the impact it had on the market, but they did have some preparation in place as they ramped up some of the underwriting policies for downturn events, putting in place more advanced tools and preparing account management process to more effectively help small business to be healthier in a slower economic time. Now, we're reopening small businesses, and I hope you're wearing your mask as you go out. I encourage you to. Folks are getting back to work, even though the environment that they're in is a little different. Even where we sit right now, a little different. So what should you take away from today? We continue to take a cautious view as the corona impacts are really continue to be felt. Even though the spread is declining in the U.S. and globally, we're seeing pockets where it's picking back up, and we'll see that as other events within the U.S. Put people closer together. As we're opening business, it's putting people closer together. As schools look at reopening, putting people closer together. Social distancing becomes harder and harder. We may see an uptick again in the virus spread. And, you know, one of the things that I pulled from the Census Bureau survey that I liked was when we talk about businesses, about 30% of businesses that they saw in their survey reported supply chain disruptions. And it's going to cause, I mean, that was within the last week. So very recent and right in front of us. So we'll have to continue to watch that as we slowly open, looking again at businesses' foot traffic and digital traffic, so overlaying some of that information on your current processes. This is really encouraging businesses to invest in their digital footprint where they hadn't before, to maintain and to bulk up on resiliency. Consumer confidence, where we should see that rise as folks get back to work. It's going to be a measured return, but that should help. We'll see hopefully some spend return a little bit. It was down about 13%, but we're seeing that pick back up, so that's good also. Delinquencies are going to rise over the next few months. We just see it as they're coming out of some of the programs that are really holding up the economy at this point. We're going to see some of that volatility in the lending market continue. One of the things that we'll look at, you know, a little more than 30% of U.S. businesses have about 4 weeks or less of cash on hand for operating expenses, so they need to be open for survivability and resiliency. So we're going to continue to monitor just cash flow, how well they're performing, what their delinquencies look like, how they are overall business health, and the impact of spread in certain areas, and other event factors that will impact that business's ability to operate. So our goal here is really to help small businesses be resilient. You know, as Christian and Derek and I talk about this, we really want to try to give you just some sight to see where the market is and how you can participate, where there are opportunities. Our goal is really to help you mitigate risk and keep your investment going in small business in the U.S. and keep it open and running. And, you know, that's really what we're here for. We want the recovery to be V-shaped more than anything. We really would like that, but it's possible to be a swoosh. So hopefully this has been helpful to you. I'd like to turn it back over to our moderator, Mr. Stockton.
Okay, thanks so much, Brody. And we've run it right up against the clock, guys. Unfortunately, we did not leave any time for questions this time, but hopefully we've been able to deliver a lot of really valuable information for you. We will be posting a recording, which we will correct the issues with the slides on the recording, so no worries on that. And also there will be a link sent around with a link to the slides if you didn't get that. For more information on Moody's Analytics, you can go to moodysanalytics.com. And for more information on Experian, obviously go to experian.com/B2B. I want to thank Christian and Derek and Brody for presenting today, and to thank you all for attending this quarter's quarterly business credit review. And we will see you next time for Q2. Thank you and good day, everyone.